Switch tracks now, though, to fixed income. Investors may be leery about bank stocks, but they shouldn't neglect bank bonds. PIMCO, manager of the world's biggest bond fund, says U.S. bank debt is a good bet now. Joining us is Mark Kiesel, who manages $80 billion in bond assets at PIMCO. Morningstar has just nominated him as Bond Fund Manager of the Year. So congratulations on that. Also with us, John Detrixhe of Bloomberg News, who wrote our story on PIMCO's bond bet. Great that you guys could join us today. I want to ask Mark, first of all, probably a question you don't get very much because you follow bonds, but you buy corporate bonds, individual companies' debt. Do you ever use expert networking firms, or do people in fixed income use those?
No, we typically rely on our internal research. We have 37 credit analysts around the globe and 30 credit portfolio managers, so 67 people. So a lot of our information is really proprietary and done meeting with companies face to face.
But you do look at companies, specific companies, their numbers, sort of the specifics there. It's interesting because you never see really bond fund managers tied into insider trading cases. It's always the equity side.
Yeah, I mean, I guess that is the case. I mean, again, we're focused on independent research and so that's what we do.
Let me talk about the independent research you've come out with. Yesterday, you were talking with John about this. He wrote a great story on it today. You like bank debt, and the reason is you think the U.S. economy is recovering. We all know that PIMCO upgraded its forecast for the U.S. economy in the fourth quarter of next year. You think that's going to help bank debt?
Well, it's not just the fact that the U.S. economy is set to run faster next year. It's the fact that the balance sheets in the banks have recovered from the last 2 years. The big banks in the United States produce about $200 billion of pre-provision earnings. The big four, Citi, Bank of America, Wells Fargo, and J.P. Morgan, pre-provision produce $130 billion of pre-provision earnings. Their Tier 1 capital ratios have gone from 6 to 9% in basically 6 quarters. There won't be a lot of issuance next year in bank bonds relative to this year. Bank portfolios are shrinking. And then finally, when you look at the valuations, Citigroup and Bank of America trade at 5.5% to 6%. These are single-A companies trading at near high yields. So the valuation is very compelling. And again, as you mentioned, the fundamentals are turning much more positively.
Hi, Mark. I had one question for you. We spoke yesterday about Bank of America and the same day that they did an offering. I just wondered, your thoughts on the valuation of that bond offering and how it's performed today. It looks like it's up a little bit in secondary trading.
Yeah, well, we bought that bond. It came at $5.97. It was a new 10-year security. The spreads have tightened about 12 basis points. In addition, 10-year yields have fallen about 8 or 9. So the yield's now probably around 5.76, so about 20 basis points or so lower. So it did perform well. This is a longer run play. Again, the U.S. banks basically got out of the gate slow, and so we think the horse is set to round the track at an accelerating rate as this delevering takes place and as these companies organically build more capital, start to make loans. I think you'll see this sector outperform, and not only on the debt side, but I think the equity side also looks good as well.
Mark, it's interesting. You like bank debt, which I understand your argument, but you differentiate between different offerings, just like an equity investor would. And you bought Bank America yesterday. PIMCO, as well as BlackRock and the New York Fed, are suing Bank America to buy back $47 billion in bonds. Don't you see a problem with that specific bank?
Well, the entire industry is acting on behalf of their clients who own mortgages. I run the global corporate bond business at PIMCO, and I see a company that is ultimately going to face some write-downs, but has organic earnings generation to offset that. Again, think about this big picture. The U.S. banking industry, again, starts off with $200 billion of pre-provision earnings. This entire putback risk is basically around $50 billion, which could happen over a period of several years. So this industry can handle that.
I have to tell you, I was sort of raised by our Bloomberg News editor, Matt Winkler. He wants us to avoid jargon like synergies and organic when we write about stuff. Explain what you mean. What is organic earnings?
Well, organic earnings simply means that as as these companies have set up reserves on their balance sheets, and as the loan portfolio has improved, as you know, housing prices went down a lot but are no longer going down much more, the reserve levels are coming down and the write-downs are coming down. So what's happening is that net income is flowing through the company, and because they're not paying dividends and because they're not making new loans, they're basically just building capital. So what's happening is their capital ratios are improving. That's the positive story on the debt side. The positive story on the equity side is that over time they will gradually start to be able to pay more dividends, and that's going to be a catalyst for the equity. But either way, this sector has been beaten down, in our opinion, and is set to really turn around. It's not totally dependent on the economy. The economy is picking up. The fact is that the balance sheet strength is there now for a turnaround.
Hi, Mark. Another question on the note you had on your firm's website. You said the U.S. is poised to run fast. Do you see that that's sustainable? How long can the U.S. run fast, or is that something that can keep going and self-sustaining?
Really good question. Well, it's really from a cyclical perspective that the U.S. economy is going to be running faster, and we think growth picks up to 3 to 3.5% next year. Probably not all that sustainable, because the growth is really trying to come through government stimulus and to try to free up some of this cash on banks as well as companies to hire and spend more. But longer term, the U.S. economy still is higher levered, both on the public sector as well as on the private sector than emerging markets. That's a long way of saying that growth could be faster next year, but longer term you want to be in emerging markets where, from a secular structural standpoint, these economies are significantly under-levered and have much more favorable secular factors than the United States.
Is that, Mark, we've seen a lot of people raise growth forecasts because of this stimulus. I think Mohammed said massive stimulus here. You got the payroll tax cut that maybe you wouldn't have expected. Is that the reason also for the big move in 10-year yields? They come down a little bit today, but they went from 2.5 to 3.5 awfully quickly.
Yeah, I mean, basically the 10-year rates are going up because real growth expectations are being revised up. Part of it is obviously due to the stimulus. It's not inflationary expectations. It's the fact is the economy is just set to grow higher because of the tax plan. In addition, if you look at corporate earnings, both cash flow and profits, they've been healthy now for about 18 months, and that tends to be a good leading indicator of employment. So we are going to see a pickup in jobs. It's not going to be typical fast job creation, but it'll be better jobs, and so that will set us up to grow at roughly 3 to 3.5% next year.
What about the 10-year yield? Do we get to 5% by the end of 2011?
No, we don't think so. As a matter of fact, we think that the sell-off in rates we've seen, and by the way, in the last 6 weeks, we've seen a backup in 5- and 10-year note yields of upwards of 100 basis points. A lot of that's been due to technical selling pressure in the mortgage market, hedging of that. Bond managers have seen their durations extend. We think that backup has gone too far now, and that the market yields are actually attractive. Again, you can buy Bank of America yesterday, which we did, at near 6% yields, 10-year rate, single-A bond. That's very attractive, and we think investors will have interest.
We were just going through your note here, me and John, looking at the taxable Build America bond muni spread. You think they're attractive. Yesterday I was talking with Jim Chanos, who is granted a bear and a short seller. He is very concerned about the municipal situation, and obviously there are some serious budgetary problems. Is that not a headwind that you worry about?
Well, you have to differentiate in the muni market. There's state general obligation bonds, and then there's Build America bonds. Build America bonds are basically bonds issued by state and local municipalities where the federal government subsidized interest to the extent of 35%. There's been 180 billion of these bonds issued over the last year and a half. The program may or may not get extended. That's still undecided. But what's happened is you can find some good, decent credits which have good quality in the Build America bond sector at roughly 6.5 to 7% yields. Those yields are very attractive relative to similarly rated corporate bonds. In fact, they're about 1 to 1.5% cheaper. And we actually can find bonds which have good credit quality in that sector. So we think it's quite attractive.
Mark, going back to your note, another asset you mentioned are bank loans and secured debt, and I wondered, is the floating rate nature of bank loans, does that make them attractive next year if we see higher rates? Is that part of the call there?
Yeah, that's part of the call. I mean, ideally, if you believe that the economy is set to run faster, and with rates rising, you want to own more floating rate debt. Bank loans also offer the advantage of being senior in the capital structure. And both with bank loans and bonds, we're trying to buy more secured debt, which means you actually own collateral protection at the top of the capital structure in companies. A lot of these secured bonds, the leverage is only about 2 to 3 times at the secured level. And so you're basically getting what we think you can get roughly 6-7% in some of the bonds and probably 5-6% in the loans at the very top of the capital structure. Quite attractive. Also, we think the agencies, both S&P and Moody's, have misrated these securities. We think they're higher credit quality than what the agencies actually rate. And so they're underrated, underappreciated, offer good value. We don't think the default rate is likely to go up. In fact, it's going down. And the recovery, if you ever were to go in default, is very high in these securities. So it's a very compelling risk reward at current valuations.
And speaking of junk bonds, lower quality bonds, do you think it's safer in 2011 to be in lower quality or to be in higher quality long duration? Where should a person sort of be positioned there?
Well, yeah, that's the ultimate question, and that really depends on bottom-up research. In general, we kind of have two feelings on that. One is you want to try to buy the double B-rated high-yield bonds, which are set to go to investment grade. These are what we call the rising stars. These are companies with great assets, which their credit metrics and fundamentals are moving up. We can buy those bonds in areas like energy and chemicals and paper and auto finance companies at around 6 to 7% right now. We think those are very attractive.